In this video, traders, I've got for you 2 trading strategies that are perfect for a beginner. Stay tuned. Hey traders, a very warm welcome to you. Thank you for joining me. If you're new here, then consider subscribing, hitting that subscription button for more videos about trading strategies, mindset, etc, etc. We cover loads of stuff on this channel. We're going to a lot of depth. Beginner videos, advanced videos to follow you on your trading journey, and we'll cover lots of markets as well. Anyway, that being said, let's get straight to it. So you're here because you want to see 2 trading strategies perfect for a beginner. So I have a lot of trading strategies in my library. Some of them have worked really well since back in 2002 all the way through. Some of them don't work so well anymore. Some of them will definitely work in other conditions. Others work consistently. However, the commonality or theme with some trading strategies is that you've always got a foundation to them. And these 2 I'm going to share with you now are the foundations that have worked forever. Now, the idea is with a beginner trading strategy is you have a base strategy and then you work with it to avoid all the noise, all the confusion. You focus on some markets with these strategies and then you start to add tweaks that are your own personality flavor to it. So you don't do anything at the beginning, you don't look at anything super complicated, you find a base strategy that you know can be effective, and then you start to add extra tweaks like the market you're trading, the time frame you're trading, all these little bits and pieces. But having those foundations are key to getting going. So the first one I've got for you guys is a mean reversion strategy. And mean reversion is really, you could better say, outside in. So in other words, as the market stretches, you're looking for it to come back to a mean being an average, and that could be something like a moving average. It could be something just literally like a prior high, a gap fill, a VWAP, which is volume weighted average price. It doesn't matter for now. All you've got to think about is that you're basically selling something or going short you think is too high, you're buying something or going long you think is too low. That's the fundamentals with it, as opposed to a trending strategy, which is you're buying something that's already high because you believe it's going to go higher, or you're shorting something that's low that you believe is going to go even lower. So that's really the difference between the 2. Now, I err on the side of mean reversion purely because you get more occurrences of mean reversion in markets than trending. However, if you're a beginner, it's worth looking at both so that you get familiar with both types of markets. You'll get a much more of occurrence of this type of trade than you will this, but recognizing the difference between the 2 is really going to be helpful because it'll allow you to identify and distinguish some of the parameters with the market you're trading. That means it's more of a trending market and more of a mean reversion market. And as you become more experienced in trading, you'll have a definitive or a definite line down between the 2, and you'll have a basket of strategies in your trend trading and a basket of strategies in your mean reversion that you'll pull out and you'll use for the right type of market. So you think that it's really good to be able to distinguish between the 2, which is why I've kind of got one of each for you. So first one, mean reversion. Number 1, double top / double bottom. It might be the most simple strategy out there, but it is still the most effective when we start to add some extra rules into it. So I've got a few rules for you now that are really super simple and basic. They're effective, they work. You can then add more and more rules on, like I say, the time of day you're doing it, if you're swing trading it, what type of market you're doing it, all this stuff that really adds to the effectiveness of it. But this is something that happens day to day, week to week in every single market, and you'll see it on the chart. Okay, so what we're doing is we are looking at prior highs or lows. I don't want to give you too many rules for this one in any of these, but I want to give you rules that I know are effective. Prior highs or lows only. So we're looking for decent levels. So if you're intraday trading, that will be the prior day's high or the prior day's low. That's the only time we're looking at this. If you're swing trading, it's going to be an important level, like a 20-day high, an all-time high, an all-time low, something like that, something that indicates that it's significant and people are looking at it, right? So we wait for a break and then enter back in. So I'm going to look at it from an intraday perspective now, but like I say, swing trading, day trading, all the same, any market as well. We're waiting for a break of the high of our prior high. There's our prior high there. Waiting for a break of it. In other words, the market goes through it and then it comes back. Now, it doesn't have to do it on the same day if we're swing trading. It could be a day after. And it doesn't have to do it on the same candle if we're day trading. So if we've got a 15-minute candle now, it doesn't have to necessarily do it. But all we want to see is that the market's poked its head above what we would call resistance. It's decided that it hasn't got many more buyers there and it's fallen back down. Now, why this is such a good trade is that, yes, there are going to be times when the market just rips through highs. Yes, there are going to be times when it comes back down and goes again. Of course there are. But the good thing about this is you don't have to think about where your stop is. You don't have to think about where the risk is. You don't have to overthink about the trade or your entry. It's very simple. As the market comes back down through this level, so if we can imagine this level was 50, okay, and the market, let's say, went to 60 here. Okay, as the market comes back down and trades at 49, as soon as it comes through, you are selling short at 49. So in other words, that's the level it's come back through there. You're selling short, and your stop, which is why this is so useful, becomes 62, a couple of ticks above. And now, I'm saying a couple of ticks, it could be 66. This is up to you, so you have your flexibility. If you're swing trading, you might want to give it a little bit more room, but it goes somewhere above it, but not too far. Play around with that yourself. Very easy to look out for, very easy to implement, and a super powerful strategy, because you can be on the end of a kind of full scale reversal, you can be on the sort of kind of counter trend move that then goes again. There's plenty of options to play this game, but what I like about it and why it's good for beginners is that the risk is so structured. The entry is so structured, the risk is so structured. It's a nice foundation to start with, and I say it works across all markets and all time frames. Number two, guys, is the trend trade. So what we're looking for here is a trending market, and how you identify that, you can either use your eyeball, you can either use a linear regression, up to you. Let's not go into details too much about that, but a trend, you know what a trend looks like, and we're looking at that over a swing trading basis. It's intraday as well, but I don't want to kind of go into too much detail about intraday, because there's various parameters that we need for this on intraday. It only works with specific time frames. So swing trading, you've got a market that's been chugging along quite aggressively, pushing very high, using the stochastics on this, or the default settings, stochastics, trending market. The market starts to pull back and you want to get involved in it, right? Buying a pullback in a trend is a very good trading strategy, whether you're an uptrend or downtrend, but timing it can be quite challenging. So this is a good way of starting off your game with getting onto these trends. You're waiting for a first oversold condition. So your stochastic comes down, becomes oversold. As it comes back up into neutral territory, normally your stochastics, guys, are going to be at 80, set at 80 and 20, these overbought and oversold conditions. So as the stochastic starts to come up above 20, that's when you buy it. And again, what I like about this, keeps things simple, your stop is going to be under that low. Everything should be about risk management, and if you're subscribed, we'll go through loads of stuff. I'll talk about risk management on this channel. We're really heavy into that. Easy place to put your stop, very easy to find entry, no ambiguity to it. It's a binary thing. It's like, okay, market's pulled back, market's been in a trend, market's pulled back, stochastics have got oversold, I'm buying them when they come overbought, bang, I'm in, I'm long, my stop is here, I'm off to the races. And then you can either look for an extension through highs, or you can look for whatever. Now we can go into detail about targets and stuff, but I don't think there's any need for it now, guys. I wanted to keep this video short, sweet as possible, give you two good strategies as a foundation. They work well, you can add more flavor to them. Again, adjust the markets you're trading, adjust the time frames you're trading, adjust when you take them, but it's a good starting point. Two trading strategies, perfect for a beginner. If you like this kind of stuff, give it a thumbs up, much appreciated. And if you haven't subscribed, then hit that subscribe button, and I'll see you in the next one. Take care, bye bye.